Today we will talk about the Fed, which just cut rates, and it is crucial to dig deep into this decision to truly understand its implications. The Fed reduced rates by 0.25 or 0.25%, and on the surface this might sound like a win, cheaper borrowing costs and the potential for stocks to rise. But there is a key detail few are highlighting, and it is essential to grasp. The Fed's own projections reveal warning signs that demand attention. GDP is slowing, inflation remains stubbornly sticky, and unemployment is inching upward, particularly among Black Americans and college students. If you are not paying close attention, this rate cut could end up harming you more than it helps. In this analysis, we will break down these trends. And by the end, we will explain why the 2 additional rate cuts the Fed has planned for this year may benefit Wall Street but leave everyday people struggling. First, we need to look at the Summary of Economic Projections (SEP), which serves as the Fed's plain language forecast and cheat sheet for key economic metrics like GDP, employment, inflation, and interest rates. This document lays out what the Fed expects for the economy, though it is important to note the Fed is not a group of magicians. Its role is to steer a $27 trillion economy using forecasts similar to how market analysts operate. But with the weight of official responsibility and significant funding behind it, the Fed has a dual mandate to foster maximum employment and maintain price stability. The latter meaning ensuring that goods and services remain affordable for consumers. Within the SEP, you can find projections for unemployment and inflation from 2025 to 2028, as well as long-term estimates. Each policymaker's projections are based on the data available at the time of the Fed's meeting, combined with their assessment of appropriate monetary policy, including the path of the federal funds rate. Fed policymakers from across the U.S. gather to vote on critical actions, whether to cut or raise rates or to implement quantitative easing, which involves injecting more money into the market. It is also important to remember that the Fed is an independent entity, not part of the government, for anyone looking to deepen their understanding of the Fed's origins. The Creature from Jekyll Island is a foundational, albeit older, book that sheds light on its structure while it is not a new text. It offers valuable context for how the Fed operates. When we look at the SEP's GDP projections, the picture is clear. Growth is weak. The Fed now forecasts 1.6% GDP growth. A slight uptick from the 1.4% projection in June, but still minimal. Slow GDP growth is analogous to an engine running out of gas. And the Fed's rate cut is an attempt to give the economy a boost, but 1.6% growth is nothing to celebrate. In fact, it barely qualifies as growth at all. This slowdown matters because it directly impacts corporate earnings, which in turn affects investment portfolios. Beyond that, it raises critical questions about employment. If economic growth slows, job creation typically follows suit. America's economy is built on consumerism, meaning it relies on people spending money, and people can only spend if they have jobs. This connection is key to understanding why slow GDP growth is a red flag, not a minor blip. Next, let's turn to unemployment. The current unemployment rate stands at 4.5%, and the Fed projects it will stabilize at 4.2% in the long term. This projection is a quiet admission from the Fed that job losses are ongoing, and if hiring continues to slow, more rate cuts may be necessary. For workers, this means their paychecks are at risk. For investors, it means slower consumer spending, which further pressures corporate earnings. The SEP also makes it clear that labor market weakness will persist for the rest of the year. With 2 more Fed meetings scheduled in 2022, for one in October and another in December, unemployment could worsen before it begins to stabilize, adding another layer of uncertainty for households already feeling financial strain. Inflation is another critical piece of the puzzle, and the Fed prioritizes the Personal Consumption Expenditures (PCE) index over PPI or CPI when making policy decisions. Core PCE, which excludes volatile food and energy costs, is even more important for guiding the Fed's actions. Right now, PCE inflation is at 3%, and core PCE inflation sits at 3.1%, both well above the Fed's 2% target. This means inflation is not yet under control, and cutting rates too aggressively could cause it to flare back up. For everyday people, this is not an abstract concern. Groceries, rent, and gas prices still feel high, and the Fed openly acknowledges that lower-income households are bearing the brunt of this pressure. The disconnect between the Fed's rate cut and persistent inflation raises a key question. Why cut rates if inflation has not yet fallen to the target? The answer lies in the Fed's dual mandate, balancing inflation control with supporting employment and growth. But it also means trade-offs that will impact households differently when asked if a 0.25% rate cut would meaningfully change the economy. Fed Chair Jerome Powell described it as the start of a process, a clear hint that more cuts are on the way. However, the Fed has faced questions about its credibility in recent years, since 2015. It has repeatedly predicted it would hit the 2% inflation target within 2 years, but it has yet to achieve that goal. When pressed on this, the Fed has argued that long-term economic forecasts are inherently uncertain given the unpredictability of global events. Adding to this, the Fed has noted that Black and brown Americans, as well as low-income groups, are being hit hardest by current economic challenges, raising the question of who this rate cut policy is really designed to help. To fully understand the Fed's actions, we must also examine the federal funds rate, which is the interest rate banks charge each other for short-term loans. In June, the Fed projected this rate would be 3.9%. It now stands at 3.6%. This shift matters because the Fed is walking a tightrope. Too many rate cuts could reignite inflation, while too few could push the economy into a recession. External factors, like tariffs, add another layer of complexity. While tariffs may generate revenue for the U.S., the costs are rarely absorbed by corporations. Instead, they are passed on to consumers, who end up paying more for everyday goods. Looking ahead, the odds of 2 more rate cuts by the end of 2024 have risen significantly, from 62% before the latest Fed meeting to 82% afterward. This will make borrowing cheaper for large financial institutions, the big dogs, and will likely push the stock market higher. But everyday people are unlikely to see the same benefits. The Fed's projections also show that the federal funds rate could fall to 3.1% by 2028, a signal that ongoing easing is planned. But it is critical to remember that rate cuts are not a sign of a strong economy, they are a response to weakness. 2 more cuts this year are not a cause for celebration. They are a warning that the economy is more fragile than it may seem. This rate cut is a double-edged sword. On one hand, it could present an opportunity to invest and build wealth as the stock market may continue to rise. On the other hand, it requires caution if the cuts are only propping up weak growth. Protecting your finances, whether through building emergency funds or choosing stable investments, is essential. The key is to avoid cheering for rate cuts without asking why they are happening if the goal is to prop up a struggling economy. You need to take steps to safeguard your financial future. Finally, consider these questions. Do you think the Fed will cut rates again this year? Would you like a deeper dive into which stocks may thrive in a rate cut environment? If this analysis has helped clarify the Fed's actions and their potential impact, share it with someone who could benefit from this context. Understanding these trends is the first step toward making informed financial decisions.